Okay, good day students. Today we're going to do study unit 6, which is the analysis of financial statements. At the end of this, or the outcomes, you should be able to appreciate the analysis using different types of techniques. Now there are various techniques, but we're only going to concentrate on one. You must be able to determine the performance and the financial position of a firm. Now remember when we did statement of comprehensive income and statement of financial position, so those are basically, we're going to use those two statements to do our analysis of financial statements, which is known as financial ratios. You need to be able to perform ratio analysis. Now that's the one analysis we're going to use using liquidity ratios. Now liquidity ratio is basically you determining, is the company still liquid? Do you still have money in your account? Activity ratios, they look more at the activities. How long must they still repay you? How long does it take you to buy inventory again? Debt to solvency ratios, they look at whether the company is still solvent, if you can still continue as a going concern next year. And profitability ratios, those ratios look at how profitable is a company, right? So the analysis users, now we have certain people that use the analysis. Now this is called financial ratios. Now the reason why companies use financial ratios, because some companies work with billions, other companies work with millions. But for you to be able to compare two companies, what the financial people do, they get it to a ratio. It's easier for you to compare 25% to 20% than you comparing 65 billion to 300 million. So that's why you get it to a level where both of the companies can be compared regardless of its size or of its turnover, right? So there's certain people that use it. The first type is management. They use it for planning and budget purposes. Then you get the owners. The owners use it for financial wealth. They want to know, is their company still making a profit? Investors, they use it for returns on their investment. Any person, if you put money into a company, you want to know, will you get something out? Now that's called a return. Employees, profitability and stability. If you are working for a company, you want to know, is this company still making a profit? Is the company stable? Because if not, my advice to you is jump ship. Then you have the lenders and the creditors. They will use the financial analysis to find out, will they be able, if they borrow you money, will you be able to repay them? Clients use it to see if the company will continue to exist. That means if you buy a certain product, if I need to then get a new supplier, or will my current supplier continue to exist? Then they use the analysis. Government, they use it for payments of taxes, public, general prosperity of a community. Now, what that basically means is, let's say a company now puts up a building. Let's say, for example, Sasol wants to put up a plant in a community. The public wants to know, will it create jobs for the community? Now that's when they will use the analysis. And then we perform ratio analysis using the certain ratios. Liquidity ratios, this basically measures, can the company pay off their immediate debts? Now immediate debts is your current liabilities. Like for example, your creditors, your expenses, will they be able to pay that off? The activity ratios, how efficient are companies using their assets? Now, for any owner of a business, if you buy a machine and let's say you've paid a handsome sum for the machine, you want to be able to know if they're using the machine, one, if they're using it to its full capacity, because if not, then you've basically wasted money. To solvency ratio, that measures, can the company pay off their debts in time? And then profitability ratios, they basically determine how profitable is a company. Now you need to know these are all theory type questions. In our next video, I will be doing a ratio analysis question. And you know, this is actually straightforward. The most important thing is you need to know the ratios. Once you know the ratios, you go and look for the amounts on the question, and Bob's your uncle, the question is done. Thank you so much, students. See you.